Let's get to our wrap the week segment. I did want to start though with our poll. We asked a poll recently: will the next 10% move in the S&P 500 be higher or lower? Now it's funny, depending on when you answer that question, the market may have evolved a great deal. We usually put that up on Tuesday or Wednesday, so the last couple of days may have juiced the optimism just a touch or two in terms of what the answers might be. But 2 out of 3 of you said almost that said the next move in the S&P would be higher. About 1 in 3 of you said lower. And again, based on the weight of the evidence, the latter half of this week, it's hard to disagree with you. I'd have to say 10% higher. If you asked me last Friday, I would probably have said the next 10% being lower. You figure about 380 points. That would put us, around 3,400, 3,350. That'll put us back to the 200-day moving average if you sold off. Adding another 380 points puts us to 4250 or so, which would be up here somewhere. That's not that unreasonable. 10% doesn't seem that much when you've had the run like we did so far this week. So 2 and 3 being more positive than negative, I can't disagree with the sentiment there. And again, that's a big change from last Friday. If you listen to the tone of last Friday's show, it was, all right, we're at the 50-day. Here's what a down move further to that might look. This is what I'm putting the bright pink lines around the 3,200, 3,250 level. Just takes a week of reversal. And again, it's not just the big broad market charts that look compelling. It's a lot of individual names. I usually sketch out random tickers as I'm looking at charts and just ideas to dig into more to think about. And I haven't had a shortage of ideas. And it's not, focused just on large cap or mid cap or small cap. There seem to be actionable charts that if I don't care about the market overall, I'm just looking at individual stocks. I don't think there's a shortage of decent patterns to be looking at right now. And that tells you, I think, a little bit about the overall scenario that we're in. There would have to be quite a downturn to make some of these charts look less positive than they are right now. Let's continue on and go through our wrap the week charts. Give me 1 second here. I actually didn't have this one set up just yet. So let's go here. Here we go. I don't have the label set up correctly, so sorry. They're going to be jumbled on the left, but I'll talk you through it here. Here's the S&P 500 in black. That's up 4.8% in the last week. What underperformed the S&P 500 this week? Here's the dollar up about 0.5%. The only two that were negative is gold, which was down 1.6% this week. Bonds down 2.5% this week. We talked about rising rates. We've talked about the strength of financials and the potential upside with given a steepening yield curve and higher yields. Certainly seems to be the trend positive in yields, down for bonds, and this week was sort of continuing on with that. Again, here's the S&P up 4.8%. What outperformed the S&P this week? This is the NASDAQ 100 up 5.3%. This is EM, emerging markets, up about 5.5%. In purple, this is small caps up 7.8%. The big winner for the week, crude oil, up 8.5%. Usually I create a second chart using including Bitcoin because obviously it given the volatility, it tends to be an outlier, tends to skew the chart a little bit. Here's Bitcoin up just over 10%. Bitcoin had been one of those where, all of a sudden we're looking at how quickly could we get back down to 20,000 with how quickly it seemed to break down and revert off of that all-time high at 42,000. The chart of Bitcoin, as we'll see here in just in a little bit, has actually held up just fine. It's actually done very nicely. And, when you think about something like Bitcoin, I was asked recently about Fibonacci retracements, and this may be the example I use for a little while, which is if you want an idea of how you use Fibonacci retracements on a longer term chart, a 6-month plus chart, Bitcoin's a decent one. As you start with the low in September, you take the high from January, there's 38.2% of the way down. And when you have this confluence of support, the 50-day moving average lining up just beautifully with that first Fibonacci level, that suggests sort of a confluence of support, a more significant support level, and we've bounced off of there so far. And based on what I'm seeing from a technical perspective, certainly seems in good shape to retest at the very least the all-time highs around 42,000. I think when it reaches there, you have to recalibrate a little bit and see where you're at relative to the momentum and so forth going there. But overall, shaping up pretty well, it seems like. So that's what happened sort of leading up to Friday big picture, let's talk about how the trends have evolved overall. Just very quickly, I wanted to just update on today's changes. So, the S&P up 4.4%, mid caps and small caps even more. So this leadership in small caps, we're going to see a little later, that long-term ratio, that long-term outperformance, it's not a new phenomenon. This has been going on for quite a while. The VIX almost down below 20 again, just below 21. Bonds, as we mentioned, weaker again today, really just continued to sell off through the course of the day. 10-year yields approaching 1.2%. Precious metals up, gold and silver both rebounding nicely. This long-term uptrend in commodities, which we've been talking about, continuing today. Most cryptocurrencies up today, with Bitcoin up 0.2%. Many others up a more significant amount. In terms of sector movements, you had materials number one. We've talked about the relative weakness in materials, but a nice bounce today for that sector. Communication services number two, and then consumer staples, which is actually an interesting one for number three. On the bottom, you have technology lagging. So the market moving higher, making another all-time high, another closing high, but tech not leading the way, which is a bit of an unusual phenomenon. Financials coming off with interest rates going higher, and then healthcare, you have the XLV just a notch above flat. So interesting to see something like staples up at the top of the list. Consumer staples and discretionary essentially in lockstep, outperforming the market today, up 0.9%. And again, the lagging of technology is sort of a head scratcher in terms of what normally should happen given a market going to all-time highs. Let's finish off this week, wrap the week segment looking at the Mindful Investor live chart list. If you've not seen this before, easy to find it. If you click on your dashboard, go to the, don't worry about that. Click on the articles, the articles tab at the top. On the right, this lists out all of our different blogs. Mine is called The Mindful Investor. And at the top, you'll see this little button that says live chart list. That's how you can save this list of charts that we're going to review right now. The first one is a market trend model, which is looking at weekly closing data on the S&P. It has a short-term, medium-term, and long-term components, all built on weekly data and essentially weekly exponential moving averages. To summarize all three of these back positive, the short-term model had turned negative last Friday on the close. I update these every Friday after the close. As of this week and early on in the week, it certainly seemed as if we were going to get a reversal back to the upside. The short-term model back positive. The medium-term model actually never technically went positive. It was really, really close last Friday. It didn't quite do it, and has remained positive. The long-term model has been positive since last June. So, the way I use a model like this is not, as a trading system or anything. It's more of an overall bias with which to approach the market. And when all three of these are positive, it tells you it's a decent time to be looking opportunistically for stocks. That's the green light to be buying good charts and good positions. The daily chart of the S&P has very quickly, from last Friday to this Friday, changed from a potential weakness, a tactical downtrend, breaking below the most recent swing low after breaking down through trendline support and approaching the 50-day closing just right below that level. And the question we had last Friday is, do we get the follow through next week? Do we break down through the 50-day? We did not. We bounced right off it. This is a bullish harami pattern, a long down day, a long up day. The second day's body is engulfed by the first day. So the second day is a little narrower, but still a long up day. And that's a short-term rally signal that really just continued through the course of the week. Today on Friday, we get a new all-time high for the S&P, a new closing high almost to 3,900, nearing that key psychological level of 4,000. Worth noting, by the way, the RSI not overbought. So the market breaking to new highs and the RSI not overbought overall is a good thing, because the move is not over. That tells you there's potential for more upside there, more gas left in the tank, if you will. If we would roll over next week, you'd start to get a potential bearish divergence. That's sort of what's on watch there. I color code the cumulative advanced decline lines based on just subjective look at these trends and whether we're making higher highs and higher lows or the opposite. I color coded a couple of these orange last Friday as they'd broken down through their 50-day moving averages. All of them now have reverted back. These aren't quite updated for today's close, all of them yet. I would not be surprised, though, if all of these have made new highs once all is said and done, and confirms certainly the breadth very supportive of the recent move. One of the challenges the market has had as it's gone higher over the last month has been a declining number of new 52-week highs. So the market going higher, but less and less individual stocks making their own 52-week highs. and it really disappeared last week. You almost went to zero. That's all starting to increase. And again, we don't have today's reading just yet, but it's been increasing more and more through the course of this week. So an expansion in new highs, especially going into next week, is something I'll be looking at just to confirm that there is a broad advance. It's not just a smaller number of stocks. Interesting sort of good news, bad news from the percent of stocks above their moving averages. This is something we use regularly to measure overall market participation, right? How many stocks are above their moving averages. Down at the bottom, it's the percent of S&P names above their 50-day. One of the things we highlighted in mid-January, late January, was the higher highs in price, but how the indicator was trending downward, suggesting less and less stocks remaining above their 50-day as the S&P was doing so. That indicator went below 50% for the first time since last October. This was in the market sold off last week, bottomed out just above 40%. Since then, it's gone back higher, and it closed almost at 68% of the S&P above their 50-day moving average. So that's actually pretty constructive, the fact that it's gone from 40-something up to 60-something. But what's interesting to me, think of it a different way, at the peak here at the end of last year, about 87% of the S&P above their 50-day. Now it's about 68, 67%. So 20% of S&P names then, hypothetically, were above their 50-day, broke below their 50-day, and have not gotten back above them. And that's a bit of a concern, right? So that means the market's rallying, making new highs back above its 50-day, but about 20% of the S&P has not participated in that recovery yet. So it'd be interesting to see if that line continues to go higher. I think that would further validate the potential for new highs in the S&P. Sentiment we talked about pretty deeply yesterday, so I don't want to beat it too much, but pretty much mixed, even responses between bullish and bearish on the AAII survey. The name exposure index back to what I would call a healthy bullish. It's not euphoric. It's more constructive. It's more optimistic, I would say. And so that's good. I mean, I think if you're bullish on stocks, you don't want to see extreme bullishness on some of the sentiment readings, because what it tells you is the anecdotal last buyer has participated. That's what creates the conditions or reflects the conditions that there's no one left to push the price higher. That's come off a little bit. So basically suggests there could be further upside. The other part of that, though, the Ridex flows, which looks at flows between, bullish, what you'd consider bullish funds, things like sector funds, index funds, and traditional offense versus defensive money market sort of funds. It's 0.1%, which is an extreme low level. It's an all-time low. We're on this chart, which is inverted, sort of the highest peak that it's been. So, overall, it's suggesting still at a euphoric stage. Offense still outperforming defense when you look at consumer discretionary versus consumer staples. Semiconductors a bit of a concern. So this ratio is rolling over just a bit. It's not the end of the world yet. It's not really breaking down through any trend lines or anything, but something to watch going into the next week. Today, as you saw, technology underperforming the market, semiconductors underperforming as well. And that's not the scenario that tends to be a good signal for the overall market. Having said that, again, consumer positive, small caps continuing to outperform large caps as we finish off the Mindful Investor Live chart list. The equal weighted S&P has come off a little bit. You can see the last week, you'd expect it maybe to be outperforming because it's been doing so well, but it's actually pretty even, which means the mega caps have been holding up okay. Growth continuing to outperform value by any measure that we would do it in the last couple of days. High beta coming back up versus low volatility. US strongly outperforming global stocks in the last month. That's with the dollar popping up a little bit. EM continuing to outperform. EFA, meaning emerging versus developed markets, and stocks over bonds. Nothing on this chart telling me that that's changing anytime soon. That is our wrap the week segment, hitting on some of the key charts, price, breadth, sentiment ratios. I hope this made you think a bit about your perspective on the markets.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.